And finally, we have part 3 of our webinar presentation this morning, which deals specifically with housing demand and supply forecasts and over-under valuation patterns and forecasts for the Inland Empire. This is where we really combine all of the information that's been presented in the previous sections and flow that through our model such that it really describes what we think this next cycle looks like in terms of the housing market for this particular area. Now, first we'll show you the results of the housing supply and demand section of the market. What this shows is this green line represents our measure of overall demand in this particular region, including our 5-year forecast. You can see that there's some seasonality throughout that as jobs go up and down, and jobs is one of the main drivers in this particular model. The next is our supply trends and forecasts. The trends are quite easy to put together. It's based on and founded on census data, and then we fill in the between census years using permit data. Then we add to that our 5-year forecast. When you have gaps between the two, when demand rises above supply, you have a period of excess demand, which tends to cause periods of appreciation and strong market conditions. When demand is below supply, which it was for much of the 1990s, you have a period of oversupply where prices are soft or are falling. That's actually the state that we're in right now. In fact, it's really kind of an unprecedented level when you compare demand and supply in terms of this oversupply. It's not because we've been building too many homes. Rather, it's because we've lost so many jobs, and that is reflected with this declining demand curve during the past few years. Let's show this a different way. This is actually the measure between the two curves, between supply and demand. As you can see, we had very high levels of oversupply in parts of the 1990s. That was followed by an extended period of time that peaked in year 2006 with excess demand. But when we began to shed jobs in 2007 and thereafter, that demand level fell off very quickly relative to supply, and has resulted in a market today which is significantly oversupplied. Now, I need to qualify that oversupply segment. It doesn't mean that we're building too many new homes. In fact, we're building very few new homes, almost a record low level of new homes in this particular market. But even if we built no homes in this market, in an atmosphere where we continue to lose jobs, we're going to create increases in oversupply. That's just how the model works, and that's a description of that economic foundation that supports new home sales in a given market area. If you're not creating the jobs, indeed if you're losing those jobs, you're going to lose the demand that goes along with that economic growth or loss. There is another side of the equation, though, a lot of economists tend to ignore. It's fine to describe this market as oversupplied. It is, but you can do well in an oversupplied market if you are also undervalued. And in this market, we are extremely undervalued, and that's really shown here. What this pattern shows, the green line in this case, shows our measure of where we think prices should be. And what that price level corresponds with is the long-term relationship between household incomes and price, or more specifically cost support, which incorporates mortgage rates. That is combined with our economic data to really tell us where prices should be relative to those household incomes. And as you can see, when we dramatically dropped mortgage rates at the end of year 2008, we actually increased our ability to afford more home price. Now, that home price that we're able to afford is still much, much lower than this inflated artificial level that we peaked at in year 2006, but it's still much, much higher than where we are today. This period that you see here, where actual prices far exceeded what the overall price should have been based upon economic support, is a description of the bubble that burst back in 2007-2008. That bubble burst to the point where it overcorrected dramatically. And part of the reason that there was such a dramatic overcorrection in price is because of the fact that we had a financial crisis which made it almost impossible to get a mortgage, almost for anyone, regardless of what your credit was. That took away the demand really from under the market's legs, and the result of that was that prices really plummeted more than they should have. Now, we should have had a major correction. We're just saying that prices overcorrected by quite a bit. And the difference between where prices are now, and there has been a bit of an uptick in price, and where they could be based upon income support, is what we measure as undervaluation in this case. And you can see that level of very high undervaluation where we are right now. Now that comes off of a period of extremely high overvaluation, described as this bubble that began in 2004 and continued through the bursting period of 2007-2008. An ugly period. We've lost a lot of value in the Inland Empire. Nonetheless, we are undervalued relative to that long-term relationship between household incomes and home costs. That undervaluation is the reason that we're seeing such significant gains in sales volume. In fact, you saw that in the first section of this presentation. It's not the economic growth that is driving those increases in sales volume. It is undervaluation, and that will continue for a bit longer until the economy really begins to rebound. Then we'll enter into a period where part of the recovery is based upon undervaluation, part of it is based upon economic growth, till finally economic growth will completely recover and take over that as we head back toward equilibrium in terms of value. When you put those two patterns together, both overbuilding and underbuilding through the years with overvaluation and undervaluation, and they do tend to be somewhat countercyclical, when you put those two together, it does create what I call an opportunity risk index. Now this index is predictive by about 24 months, and so this very low index that we created in, say, year 2007, one of the lowest indexes on record at 92.2, didn't describe the weak market in 2007. Even though it was beginning to be very weak, it was really describing the market, what the market was going to be like during year 2009. Now in year 2009 we actually had a very high index, one of the highest indexes on record, because prices had plummeted so far. The result of that is that we think that there is going to be relative stability and even strength during year 2011, 2 years thereafter, which is about a year from now. 2010 is more of a stabilizing year, and that stems from this stable index that was created during year 2008. Based upon this, we think it leads to these appreciation rates, or these price changes during the next 5 years, of 2.7% during year 2010, followed by 3.8% in 2011, 4.4% in 2012, 6% in 2013, almost 8% during year 2014. We think that those pressures, mainly stemming from an economy that is taking care of the overbuilding problem and severe undervaluation, leads to increasing appreciation over time. It begins modestly. I know in some areas it's actually begun, some feel quite strongly, but we think that it begins modestly and it grows from here. But we have seen positive change during the past 12 months, and we think that those patterns continue. That is our overall description of the Inland Empire. I'll leave you by sharing with you some information regarding the services that we offer, both on a consulting side as well as our online information tools that are offered on our website at www.realestateeconomics.com. We'd love to be more involved in your development or information needs, and here's some contact information for you. Thank you very much for joining us this morning. We hope that you'll join us next week as John discusses the San Diego market in Southern California and lends special insight regarding what's going on there. Thanks, and take care.